Hey guys, welcome back. It is time to talk Disney again after Disney releases their Q1 2024 earnings. I did my first video for you guys on Disney back in August of 2023, and a lot of you hated that I suggested taking a look at Disney as it dropped below $80. That would be right here when it dropped under this green line on the far left side of the chart. I got my first entry at around $83. And I picked up some more as it went below 80 bucks with the low coming in at $78.48. I know a lot of you weren't believers in Disney. Maybe you hate their political agenda. I might not like it either, but I am looking for value investing deals for myself, and when I find them, I'm going to tell you guys about them. Disney soaring over the past couple months, and again today, based on the earnings, with a high today of $112.77, closing the day at $110.54, a 40% run up since August of 2023 on a profitable blue chip company. Almost a no-brainer. And on top of that, Disney pays a dividend, and they announced this week in the earnings that they're increasing the dividend by 50%. Let's go through the details. When I am going through the dustbin of blue chip companies looking for potential value plays, I'm looking for a couple of basic things. Companies that have a long history of growing revenues, and Disney has that going back for decades. Second, we're looking for companies that have a long history of positive earnings, and Disney has that also, although they have been struggling a little bit over the last couple of years, as we can see here, and some of that was due to COVID. Can they recover? That's what we're going to be looking for every quarter as we continue to watch Disney. But this quarter that they just finished marks the highest ever top-line revenue for Disney, and they brought in a healthy net income of $1.9 billion. Compare that to the previous quarter of $264 million or negative $460 million 2 quarters ago. That is a great recovery. And the third thing that I'm looking for is stocks that you hate. Not you specifically, but if a company that has a long history of success is out of favor, then I want to dig into that company and ask myself in my due diligence, do I think that management over the long term can correct this problem? And that really encapsulates the bet here on Disney is I think over the long term, they can and will correct the problems that they have been experiencing. Keep in mind, this is not a get rich overnight play. Even though we got a 40% run up over the past 5 months, Disney still has a lot more upside potential. And a lot of you in August were leaving me comments after a week saying, oh no, Disney went down a couple dollars. Get on my timeline, guys. I'm looking out 1 to 5 years. I'm not looking at next week. This is a value investing play, a long-term bet. So have the right timeline when you're watching these videos with me. Looking at the dashboard for Disney, my pictorial visualization for you of how I perceive the risk on Disney. A lot of things have improved on here since we looked at it back in August. A lot of the yellow boxes have flipped to green. That bottom one on the left, the dilution risk, they announced share buybacks for this year. We're going to talk about that in just a second, but I do want to also highlight to you that the current ratio or working capital did flip to red due to a reduction in cash on the balance sheet, and we're going to talk about that briefly in this video also. How did Disney achieve these results, and why is the stock soaring this week? Let's go over a couple of the highlights for management. They wanted to let us know that they achieved over $500 million reduction in SG&A and other operating expense savings across the entire enterprise in the first quarter. Based on the strength of the first quarter results, as well as their expectations for the balance of the year, they expect full year fiscal 2024 earnings to increase by at least 20% versus 2023 to approximately $4.60 earnings for the year. In February 2024, the board of directors approved a new share repurchase program effective February 7th, 2024, and they plan to target $3 billion worth of share repurchases in fiscal year 2024. And finally, as we talked about that dividend in the beginning of this video, on February 7th, the board declared a dividend of 45 cents per share, which is an increase of 50% versus the last dividend, which we just received in January of this year. And that increased dividend will be paid on July 25th, 2024 to all shareholders of record on July 8th. Other exciting news from Disney this week includes an announcement that they will be combining their ESPN Sports, teaming up with Warner Brothers Discovery and Fox to launch a new streaming service that will combine the three companies' extensive sports rights into one app, and that is expected to launch in the fall. I have an article for you just on this deal, and I'll put a link to it in the video description, as well as links to everything else that we discuss in today's video. Disney also announcing a new deal with Epic Games on Wednesday to build a new entertainment universe based on the blockbuster Fortnite. That deal includes a $1.5 billion investment by Disney for an equity stake in Epic. What does this partnership mean exactly? I'll put a link to this article in the video description for you, but it says that consumers will be able to interact with stories and characters from Disney, Marvel, Pixar, and Star Wars on Epic's Fortnite. CEO Bob Iger said, in terms of total media screen time on video games, it was stunning to me, equal to what they spend on TV and movies. And the conclusion I reached was, we have to be there. Disney has to be there in gaming. And so they are making this investment into Epic. And Bob Iger goes on to say, we have to be there as soon as we possibly can in a very compelling way. Now, does this improved quarter mean that Disney is out of the woods? No, it doesn't mean that they're out of the woods, but we see that things are improving. Disney has their annual shareholder meeting in April, and activist investor Nelson Peltz is waging a proxy war with the board. We're going to keep you up to date on that as things progress. But in this article from the Wall Street Journal, they say that this does show a company on the right path and in less need of outside intervention. Most notably was the sharp reduction in streaming red ink. You know, those losses all these companies are taking on their streaming services. Disney's operating losses of $138 million for the DTC segment, direct to consumer, were about a third of what analysts had expected, and were a vast improvement from the nearly $1 billion in losses for the same period the previous year. They go on to say that Disney's results still had plenty of weak spots. The company's linear networks revenue fell more than 12% year over year, nearly double the rate of decline from a year ago, and the weaker movie market, plus some recent misfires with its own films, caused Disney's theatrical distribution revenue to sink 78% year over year to $251 million for the quarter that they just finished. Bob Iger has laid out a strategy of quality over quantity, and he's told us that they plan to focus on putting out fewer films in the next year or two, but making sure that they are quality films, and we will need to keep an eye on that. In terms of the park experiences, since we last talked, World of Frozen in Disneyland Hong Kong opened November 20th, 2023. Zootopia opened in Shanghai, December 20th, 2023. The Journey of Water, inspired by Moana, opened at Walt Disney World here in the US, October 16th, 2023. And in Disneyland Paris, we have the Disneyland Hotel opening in January 2024, and the Pixar Place Hotel opening up at the Disneyland Resort also in January. As always, I encourage you to read through the entire 10Q and listen to the earnings call, which is on the Walt Disney World Investor Relations website. But at a very high level, let's talk about some of these results. Looking at Q1 2023 versus Q1 2024, revenues were basically flat, but there is an increase on income before income taxes, total segment operating income, and a healthy increase on earnings per share. Looking at the breakout of the entertainment results, linear networks is down, direct to consumer was up, and the content sales and licensing was down. They say lower results versus the prior year due to performance of theatrical titles. You know, all those plushies and everything that they sell related to movies. When your movies are suffering, the content sales and licensing income also suffers. Operating income for this segment of the business shows a slight decline from Q1 2023. Looking at Disney Plus, both domestic and international over the last several quarters, basically flat. Here you can see on this top bar chart, international, there was an increase, but the nice thing to see here is the ARPU, that average revenue per unit, increased from a year ago from $5.95 to $8.15 for domestic, and from $5.62 to $5.91 for international. Disney attributes these increases to increases in retail pricing for these products. Hulu total subscribers increased by 1.2 million versus the prior quarter, with ARPU increasing by 18 cents versus the prior quarter due to increases in retail pricing, partially offset by lower per subscriber advertising revenue. ESPN domestic and international revenues were basically flat, but you can see a big increase on the ESPN domestic operating income and an increase in the loss down here in green and yellow for ESPN International and Star. Disney tells us that that increased loss for the Star segment was due to the International Cricket World Cup, resulting in higher programming and production costs, partially offset by higher advertising revenue. Looking at the domestic and international parks, what they call the experience, you can see that there was a slight increase on revenues for domestic parks and experiences. Everything else on here is pretty much flat, including the operating income. As we wrap this up, when we were looking at that dashboard earlier in this video, I said that the working capital was a red flag to me. They got a red box on my dashboard for this decrease in cash from 14 billion last quarter to 7.1 billion this current quarter. And I like to dig in and find out what is the reason when something like this happens. Flipping over to the cash flow statement, we see that there was a big expense here in the financing cash flow, $8 billion. And when I go over to the details in the filings from the company, all the way down on about page 45, there is an explanation for where $8 billion went. And it basically says that this was related to non-controlling and redeemable non-controlling interests in the current and prior year quarter were due to payments for redeemable non-controlling interests in Hulu and BAMTech, respectively. I don't expect that to be an ongoing thing. I think that was a one-time expense, but if you have a different viewpoint, please let me know down in the video comments. So where do we go from here? Well, obviously we need to track Disney's progress through the quarters of this year as we decide what we're going to do with our investment in Disney. There were a bunch of analysts that changed their rating to buy or strong buy on Disney with price targets I see here of 120, 125, and 128. The general consensus for Disney is a buy. 7 analysts that have a buy recommendation and 10 that have a strong buy. Average price target over the next 12 months for Disney is $110. Surprise, that's where we ended up the day today. And the high forecast, $130 over the next 12 months. And a low forecast of $76. I hope you found this video useful. For a quick summary on the Q1 2024 results, I really hope that you paid attention back in August when we called this stock out to you in the $80 price range. What a nice run up from August to February. Hit the subscribe button if this is your first time here. Share the video with a friend. I am Tony Denaro, and I will see ya on the next video.